When you apply for credit, the bank or company that is deciding whether or not to lend you the money for the car or house or credit card is looking at all areas of your financial picture. These areas are easy to remember as the 4 C's of credit, since they all start with the letter C. We're going to cover credit history in this video, and I'll break it down into 4 easy to remember areas. The first is, how long is your history? When was the first time you opened a credit account? Even if that account is now closed, this shows how long you've had experience with credit. Of course, longer is better, but having at least 3 years of history is good. Second is your mix or types of credit. These can be broken down into 2 broad categories of installment loans and revolving credit. Examples of installment loans can be car loans or home mortgage loans. These usually have a fixed rate and payment each month, and when you make the last payment, the loan is done. Other accounts like credit cards and lines of credit are called revolving because you are approved for a spending limit and can borrow some or all of that limit. When you make payments, it opens up your ability to borrow again up to the limit. So you can borrow, pay down, borrow again, and it stays open. Next, let's talk about utilization or balances on your accounts. This is especially important with revolving accounts, which usually have smaller payments due, like interest only, and you aren't forced to pay them off. It's easy to carry balances and end up not making progress in paying them off. It can look like you're spending more than you make if the balances are too high or you carry them too long. And this has a big impact on your credit score. 2 good rules of thumb are to not owe more than 20 to 25% of your limit on a consistent basis, and to make sure you pay these off completely every 12 months. These should be short-term borrowing tools. I would mention that it's okay to make a big purchase and take a few months paying it down. It's the progress that counts. Okay, here's the last one, and this is critical. You have to make on-time payments. Even a few late payments can trash your credit score. These are payments that are at least 30 days late, and lenders do not like to see these. With credit, it's the main promise you make. I will pay you back. When it looks like making payments isn't a priority for you, it gets hard to get approved or save money by getting the best rates. So make sure you have a plan to stay organized, even using tools like automatic payments and reminders to stay ahead of the game. There you have the key areas of credit history, which is the first C in our 4 C's of credit series. Next up is capacity, so make sure to keep watching.